In plain simple terms, transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. What this means, transaction price is not always the cash price, rather, this must also take into consideration discount or any other forms of concession that you give to the customer or even discount that you expect you will eventually end up giving to the customer. In other words, you don't only consider discount that you will give now, but you will also consider discount or other forms of concessions that you may offer in the future as well. This is the reason why I said transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. Here is the definition of the transaction price as written in the textbook. I'll take a pause for a few seconds for you to read it. Don't worry if everything doesn't make sense. We'll break this down during the course of our discussion, and I'm sure you will see things becoming clearer as we go along. Okay, you must have read the definition, but let's go back to what we said at the very beginning. Transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. This is the key idea, and that's why I have been emphasizing this time and again. My recommendation is, whenever you think of transaction price, just let this idea light up in your head, and trust me, this will make rest of the evaluation easier to do. Let me now break down the transaction price into pieces that make it up, and we can then discuss each one of them one by one in detail. Once again, transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. Transaction price can be either fixed amount or variable amount. Transaction price can be paid in the form of cash or non-cash, for example, shares. And finally, transaction price may have to be adjusted for consideration payable to the customer or significant financing component. I'll take a pause. You please have a look at it for a few seconds. Okay, back to our discussion. Fixed amount is exactly what the name says, that is, it is fixed. In other words, it doesn't change. For example, you sell a cell phone to a customer for $50 cash. Then, transaction price in this case is $50 and it is fixed, nothing complicated here. Variable amount, or call it a variable consideration, is exactly opposite of fixed amount, meaning transaction price may vary over the course of the contract term, and that's why it is called variable. Variability in the transaction price may arise due to many factors like discounts, rebates, credits, concessions, penalty, renewal options, and so forth. A typical example of variable consideration will be volume discount, where you may offer varying amount of discount to your customer depending on level of sales they achieve. It is also possible that you can have fixed as well as variable consideration in the same contract. For example, you can have fixed price for product A and variable price for product B, where price may vary at different level of sales. Since amount of variable consideration will be unknown, therefore, you will have to make an estimate of the variable consideration to determine the transaction price. Standard has prescribed two methods to make this estimate: expected value method and most likely method. You should apply expected value method where a range of outcomes are possible, and you should apply most likely method where usually only two outcomes are possible. While making an estimate using expected value method, you should assign a probability for each possible outcome and then calculate weighted average price. And the price so calculated is the estimated transaction price. In case of most likely method, you should evaluate which of the two possible outcome is most likely to occur, and the price associated with that outcome is the estimated transaction price. Once you have made an estimate of the transaction price, you must also apply a constraint to your estimate, meaning you should limit the amount of your estimate to an amount such that revenue reversal in future is minimized. I think it became too much, don't worry. Following example will clarify what all this means. Say you have given following discount offer to your customer that if he achieves sales worth 100k, then you will offer him 10% discount. If he achieves sales worth 200k, then he'll get 20% discount. If he achieves sales worth 300k, then he gets 30% discount. And if he achieves sales worth 400k or more, then he will get 40% discount. In this example, multiple outcomes are possible because discount percentage will vary across the range of volume of sales, and therefore, in order to make an estimate of the transaction price, expected value method will be more appropriate. To get an estimate of what discount will be offered to the customer, you need to make an estimate of the level of sales customer may achieve. We can make this estimate using expected value method. Say, there is a 40% probability that sales worth 100k will be achieved. There is a 30% probability that sales worth 200k will be achieved. There is a 20% probability that sales worth 300k will be achieved. And there is a 10% probability that sales worth 400k will be achieved. If you do the math, as shown here, it turns out that likely amount of sales will be 200k, and therefore discount that will likely be offered is 20%. So, transaction price in this contract will be 200k less 20% discount, which will be equal to 160k. Once you have determined estimated transaction price, you need to apply constraint on your estimate so that you can limit amount of your estimate to an amount such that possibility of revenue reversal in future is minimized. Say in a similar transaction in the past, in addition to contractual discount, you have also offered additional 10% discount to your customers. So in this case, you should also factor in this 10% additional discount in the transaction price. So revised transaction price will be 160k less 10% additional discount, which will be equal to 144k. This constraint is an attempt to ensure that revenue is not recognized, which is likely to be reversed later on. Please also note that you will need to do a true up or true down of your estimate at each reporting date based on the new estimate available. In our example, final amount of sales volume, and accordingly transaction price will be adjusted and correction will be made in the amount of revenue recognized to date on a year-to-date basis. Let us take another example to illustrate most likely method. Say in a contract with a customer, you have agreed to pay penalty of 100k in case work is not completed in time. To make an estimate of the transaction price, you should use most likely method because there are only two possible outcomes, that is either penalty will be paid or penalty will not be paid. Whichever outcome is most likely, then consideration associated with that outcome will become the transaction price. And finally, apply constraint to your estimate to finalize the estimated transaction price if there are any. You may select either of the two methods, but you must make sure that one you select would be the best one from the point of view of recognizing a revenue such that likelihood of revenue reversal later on is minimal. To do this, you need to evaluate facts and circumstances of each contract and make a judgment accordingly. There is no hard and fast rules to follow as such. Cash consideration. No fuss, no explanation needed, simply because we all know cash, right? But with the non-cash consideration, there is a problem. We have to find a way to assign monetary value to non-cash consideration. Non-cash consideration is usually in the form of shares in the company, but this can be any other goods or service as well. In order to make an estimate of the dollar value of the non-cash consideration, standard has prescribed two methods, namely fair value and standalone selling price. You must first try to determine the fair value of the non-cash consideration, and only if it is not possible to determine fair value of the non-cash consideration, only then you should make an estimate of the standalone selling price of the promised goods or service, that is, goods or service that you are selling or providing to the customer. There is a quite good amount of argument as to the timing of when to determine the fair value of the non-cash consideration. Some say they should be determined at contract inception, some say they should be determined when non-cash consideration is paid or received, some say they should be determined when performance obligations are satisfied. Though diversity in thought exists, but recommended approach to determine the fair value of the non-cash consideration is to estimate fair value at contract inception. Another very important aspect with respect to non-cash consideration is, if fair value of the non-cash consideration itself is variable, then you should make an estimate of the fair value in a similar way as you will do for variable consideration, and you will also apply constraint to this estimate as you would do in case of an estimate of a variable consideration. That is, you should limit your estimate to an amount such that likelihood of a revenue reversal in future is insignificant. Please also note that fair value of the non-cash consideration will not change due to change in the quoted market price of the shares. For example, If you receive 1,000 shares of company A in consideration for the goods you sold to company A, and at contract inception quoted market price of these shares were $100, then transaction price in this case will be 100,000. Say later, while contract is still being executed, quoted market price of the shares changes to $50. In this case, no change will be made in the initial estimate of the fair value of the non-cash consideration, and transaction price will still remain 100,000. Consideration payable to the customer. It is possible that you sell goods and services to the customer and at the same time purchase goods and services from the customer. Amount you pay to your customer towards the purchase of distinct goods and services is simply purchase in the normal course of business and therefore should be treated as such, that is normal purchases. However, there could be a situation where you make payment to your customer which is not towards the purchase of distinct goods and services. For example, this could be to help promote sale of your own goods and service. If the consideration paid to the customer is not towards the purchase of distinct goods and services, then such payment should be reduced from the transaction price. From the point of view of determining transaction price, consideration payable to the customer which is not towards the purchase of distinct goods and services is what that is relevant. So when I say consideration payable to the customer, that means such consideration is not towards the purchase of distinct goods and services. Such consideration can be paid in various forms, for example, cash, coupons, vouchers, which can be used to settle any payments or any other sorts of credit. Consideration payable to customer could be either a fixed amount or a variable amount. If it is fixed, then that amount will be reduced from the transaction price. On the other hand, if it is a variable amount, then you will need to make an estimate of that variable amount, and the estimated amount will be reduced from the transaction price. Regarding timing of estimating variable consideration, this should be done at contract inception. Let us take an example to clarify this point. Say you signed a contract with A Limited to sell 50,000 pair of shoes over the next 12 months at $100 each. You also agreed to pay them $1 million to create separate section in their retail stores to display shoes of your company. Obviously, this 1 million payment is not towards the purchase of distinct goods and services. Rather, this is being paid to A Limited to promote sale of your own products, and therefore 1 million payment will be reduced from the transaction price, and therefore total value of the contract will be 4 million, that is 5 million, value of 50,000 shoes at $100 each, less 1 million cash paid. This was the case of a fixed amount, so this was very straightforward. Say in similar transaction, you also issued a credit voucher of 5% of the contract value. If sales in the first 6 months is 60% or more of the contracted quantity, this will bring a variable element into the consideration payable to the customer. That means you will have to make an estimate of that variable consideration. After evaluating previous sales history, you determine that 60% of the sales will be achieved in the first 6 months. And in that case, you will also have to reduce the value of this credit voucher from the transaction price. This means transaction price will be reduced by another 200k, that is credit voucher of 5% of 4 million. And new transaction price will be 3.8 million. Consideration paid or estimated amount of consideration payable to the customer will be recognized as a reduction from revenue as and when goods are sold or services are provided. In our example, this 1 million payment to customer to create display section and 5% credit voucher for 200k for selling at least 60% contracted quantity in the first 6 months. We will cover accounting aspect of this with example in part 6. And finally, existence of significant financing component. Significant financing component may exist if consideration is paid a year before actual transfer of goods or service or a year after actual transfer of goods or service. So to determine if significant financing component exists or does not exist, we should begin our evaluation with the question if payment is settled within 12 months or not. If answer to this question is yes, then there is no financing component. On the other hand, if answer to this question is no, then you will need to make an evaluation to determine if financing component exists or does not exist. If the outcome of your evaluation is financing component does not exist, then no further adjustment is needed to be done in relation to financing component. However, if outcome of your evaluation conclude that significant financing component exists, then you will need to include impact of financing component in the transaction price. How financing component would impact determination of the transaction price will depend on whether existence of financing component is due to an advance payment or a future payment. If this is due to advance payment, then transaction price will be made up of imputed interest expense and cash payment. If this is due to payment in future, then transaction price will be cash payment less interest income. Discount rate, which is to be used to compute interest, is the rate that would apply to a separate financing transaction between the vendor and the customer at contract inception. This discount rate will not be changed later on, either for a change in interest rate or for other reasons, for example, change in the credit risk of the vendor or the customer. Please also remember that there is no hard and fast rules to follow to determine if significant financing component exists or not. Rather, you need to make a judgment after careful evaluation of the facts and circumstances of each case. Paying quite early or pretty late could be due to reasons other than financing and could be for a very sensible commercial reason. Consideration for the existence of significant financing component is important because ignoring this could cause similar or identical transactions showing different accounting results. For example, you sell an iPhone for $1,000 if paid cash upon delivery or $1,200 if paid after 2 years. Obviously, we are asking customer to pay more for exactly same product if they pay in 2 year time, and difference in essence is nothing but time value of money. Ignoring time value of money, or call it financing component, would mean you will recognize 1,000 revenue for cash sell and 1,200 revenue for sell on 2 year credit, which is certainly not the right thing to do. Obviously, we cannot have different revenue number reported for the sale of same product, and therefore adjustment for financing component is important. Adjustment for financing component basically neutralizes the impact of time value of money on the revenue recognition. I guess this would have given you a good overview of the concept, but let's understand this with an example to get a better insight into this. Let's first take case of an advance payment. Say today is January 1, 20X1 and you entered into a contract with the customer to sell a residential unit to be delivered on December 31st, 20X2. You propose following payment plan. He can either pay $700,000 now or can pay $800,000 in 2 years time, that is December 31st, 20X2. Customer has agreed to pay $700,000 now. You evaluate reason for allowing lower payment if consideration paid in advance and conclude that lower payment is justified because you will save interest costs that you will need to pay on the borrowed money to construct the residential unit. And thereby, this would also conclude that significant financing component does exist in this transaction. This means transaction price for this transaction will be made up of imputed interest expense plus cash payment. Implicit rate of interest in this transaction is 6.9%, whereas your incremental borrowing rate is 4%. Since discount rate to be used to calculate the imputed interest expense has to be the rate that will apply in a separate financing arrangement, which in this case is your incremental borrowing rate, so 4% will be used to compute interest expense, and here is how accounting will be done. On January 1, 20X1, you will record cash receipt of $700,000 and a contract liability of the same amount. On December 31st, 20X1, you will record interest expense of $28,000 and you will add this $28,000 to the contract liability. Year to date, contract liability balance will become $728,000. And finally, on December 31st, 20X2, you will record another $29,000 in interest expenses, which will again be added to the contract liability to make the contract liability balance on December 31st, 20X2, $757,000. And on the same date, after transfer of the residential unit to the customer, you will recognize revenue of $757,000 from the contract liability. Interest expense has been calculated at 4%, that is your incremental borrowing rate. We just talked about advance payment scenario. Let us take up a case for future payment. Say today is January 1, 20X1 and you sell the machinery to a customer for $121,000. Customer will pay you this amount on December 31st, 20X2, that is in 2 years time. Cash price of the machine is $100,000 and you have concluded from your evaluation that significant financing component does exist in this transaction, which means you will need to adjust your transaction price for the existence of significant financing component. Implicit rate of interest in this transaction is 10%, whereas applicable interest rate in a separate financing arrangement is 8%. Since interest rate to be used to calculate the imputed interest income has to be rate that will apply in a separate financing arrangement, which in this case is 8%. So 8% will be used to compute interest income, and here is how the accounting will be done. On January 1, 20X1, you will record a receivable of 104K for sale of machinery and record revenue of the same amount. On December 31st, 20X1, you will record interest income of 8K and you will add this 8K to the receivable. So year-to-date receivable balance will become 112K, and finally on December 31st, 20X2, you will record another 9K in interest income, which will again be added to the receivable to make receivable balance on 31st December 20X2 121K. And on the same date after you have received payment from the customer, you will record cash of 121K and reduce receivable balance to nil. Interest income has been calculated at 8%, that is the rate applicable in a separate financing arrangement at contract inception. Okay, time to wrap up now, and this is what we learned here. Transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. This means transaction price is not only the cash price, rather you should also take into consideration any other discounts or concessions that you may offer to the customer in the future as well. Transaction price can be fixed amount or a variable amount. If the amount is variable, then you should make an estimate, and once you have done that estimate, you should apply constraints to that estimate, meaning you should limit your estimate to an amount such that likelihood of revenue reversal in future is insignificant. And you keep doing a true up or true down of the variable consideration at each reporting date, and any resulting changes should be adjusted in accounts on a year-to-date basis. Transaction price can be paid in cash or in non-cash forms, for example in shares of the company. If paid in cash, no problem and no estimation needed. However, if paid in non-cash form, for example in shares, then you will need to determine fair value of the non-cash consideration at the contract inception, and only if it is not possible to determine the fair value of the non-cash consideration, only then you should determine a standalone selling price of the promised goods or service, and this estimated amount will be your transaction price. And finally, transaction price may have to be adjusted for consideration payable to the customer, or for the existence of significant financing component. Consideration payable to the customer which is not towards the purchase of distinct goods and services should be reduced from the transaction price. If consideration payable to the customer is a variable amount, then you should make an estimate of that variable amount, and that estimated amount should be reduced from the transaction price. Significant financing component may exist if consideration is paid a year before actual transfer of the goods or service or a year after the actual transfer of goods or service. Existence of significant financing component would cause transaction price to be adjusted for interest expenses or interest income. You should evaluate each case to determine if significant financing component exists, and if existence of significant financing component is due to advance payment, then transaction price will be equal to cash payment plus imputed interest expense. On the other hand, if existence of significant financing component is due to payment in future, then imputed interest income will be reduced from the cash payment to determine the transaction price. Right. So this concludes part 4 of this 7 video series. I hope this video did enhance or improve your understanding of the transaction price concept, and if it did, then I feel rewarded. Thank you so much for watching. We'll see you soon in the next video. Thank you.